What are the different type of mutual funds available in India? That's our topic for discussion today in the Market Secrets investment series. Before we get into the session, I would like to mention two things. We are not going to talk about regular versus direct plan of the mutual funds. You should always go with direct plan like we discussed in the earlier episodes. Likewise, we are not going to talk about dividend payout or dividend reinvestment option of mutual funds. You should always go with dividend reinvestment option like we discussed in the earlier episodes. With that note, let's talk about the different categories and subcategories of mutual funds based on the assets that they are invested in. Let's start with the debt funds, and my favorite is liquid funds. These type of mutual funds invest in high liquid and high credit rated securities with very short maturity time frames, usually less than 91 days. So these securities are CDs, that is nothing but certificate of deposit, which is like a big FD, government securities, commercial papers, and corporate bonds, mostly AA plus bonds. These liquid funds usually pay higher interest rate than the corresponding FD or savings account rates and are extremely safe. Some liquid mutual funds offer ATM cards as well, making it very similar to a bank savings account. Reliance Mutual Fund has an ATM card feature which you can associate it with their funds. But even with liquid funds, you should properly review your portfolio regularly. The next one is ultra short term bond funds. These funds invest in bonds with a maturity of 3 to 6 months in most cases. They can invest in government as well as corporate bonds. The next one on the list is Gilt short term bond funds. These are the funds which invest exclusively in the short term government securities. They are safe from credit risk than the funds which invest in corporate bonds. This is because they are investing in the government securities. The next one is short-term bond funds, which is otherwise called as corporate short-term bond funds. These bond funds invest in corporate bonds with a maturity of 1 to 3 years. The next on the list is income funds. These are usually flexible funds which can change their portfolio according to the interest rate outlook and tend to provide a less fluctuating regular income. But even though it is providing regular income, it doesn't mean it is completely safe. It still has credit and interest rate risks. The next on the list is Gilt medium to long term funds. The term Gilt refers to government. So these use government bonds which have longer maturities. Currently, some of these funds have average maturity of 20 to 25 years. It doesn't mean you have to invest for 20 to 25 years. You can invest today, you can withdraw tomorrow, it doesn't matter. But these funds will in turn use your money to invest in long term government bonds which matures in 20 to 25 years. So you need to understand this difference, and this is applicable for all the different debt mutual funds that we have discussed. And in addition to this, we have money market funds and overnight funds, which usually invest for very short duration or a security that matures in 1 day or 1 week. But these are just fancy names used to make things complicated for an average investor. A retail investor who doesn't have expertise on investing should just stick to liquid funds. And most importantly, we should avoid taking risk in the debt part of our portfolio just for 1 to 2% additional returns. Debt part of portfolio should be used for stability, and we should take all the risk we want in the equity part of the portfolio. Lot of investors will forget this basic rule and suffer in the long run because they go for that extra 1 or 2 percentage of additional returns from the debt mutual funds. Moving on to the equity funds, let's start with my favorite, which is index funds. These funds replicate the portfolio of a specific index. So a Nifty 50 index fund will have the exact 50 stocks which are part of Nifty 50 index. Even under index funds, there are two sub-classifications, a plain vanilla index fund and an equal weight index fund. Only difference between these two are percentage of stock holdings. The plain index fund will give same weightage to the stocks as the index, whereas all the stocks will have same weightage in an equal weight index fund. I am not a fan of equal weight index fund. I invest only in plain vanilla index fund. Next on the list is large cap funds. These funds invest in equities or stock of the top 30 or 50 or 100 companies. This is nothing but your blue chip companies. Cap means capitalization, which refers to total stock market value of the company. So the large cap funds will invest in the topmost companies in the country. The next on the list is mid cap funds. These funds invest in the stock of the companies which are not large. They do so by having a mandate of not investing in the companies which are in the top 50 or top 100 by the market capitalization size. Next on the list is small cap funds. These funds invest in the companies which are not in the top 250 or 300 companies. So these funds will focus on the small companies which has the potential to grow big over time. Next on the list is flexi cap funds. These have flexible mandate to invest in any group of stocks and not limited like the above three groups. They have additional restrictions like not investing in very small stocks like microcap companies. The idea is to invest in a particular group according to the market conditions. So they invest most of the money in the large cap companies during one phase and they will invest most of the money in mid or small cap companies in another phase, which will result in having the benefits of all the world in a single fund. The next on the list is multi-cap funds. This is very similar to the flexi-cap mutual funds, but there is one big difference. These funds should invest at least 25% of their funds in large cap, mid cap, and small cap companies. So the flexibility is very limited when compared to flexi cap. So when you take flexi cap, they can invest 60% of the funds in mid cap companies and the remaining in the other caps. But when it comes to multi cap, they should definitely have to allocate 25% of their funds to each of the mid, small, and large cap companies. So their flexibility is very much limited. The next fund on our list is sectoral funds. These funds invest in a particular sector only, like infrastructure, banking, pharma, etc., which are defined in their scheme documents. So if you want to invest in any specific sector, you can use sectoral funds. And the next on the list is thematic funds. Thematic funds appear like a sectoral funds on a surface, but a theme is much larger than a single sector. Infrastructure funds are usually considered as thematic funds instead of sectoral funds since the companies cut across various sectors related to infrastructure like banking and finance, engineering and construction, energy, metals and automobiles. So infrastructure will impact all these sectors. So most of the infrastructure funds are considered as thematic funds. Next on the list is regional and country specific funds. These funds invest in a particular region or country like USA or China. And the next item is international funds. These funds invest internationally without restriction to a specific country. The next is a gold fund, which invests in gold or gold ETFs or gold mining companies. Next is ethically or socially responsible funds. These funds do not invest in companies associated with sin products like gambling, cigarette, porn, or alcohol. The next on the list is balanced funds. These have variable allocation to equity and debt. This is otherwise called as a hybrid funds. They invest in both equity and debt instruments. There are equity oriented hybrid funds which have greater than 65% equity allocation, while others are debt oriented hybrid funds which have lesser amount of equity. They will have inbuilt asset reallocation strategies based on the market conditions. And the last one is ETF. ETFs or exchange traded funds are not a type of mutual fund, but it is very similar to the mutual funds. Unlike mutual funds, ETFs can be bought or sold during the trading hours on an exchange just like any other stocks, and these track the price of the underlying portfolio. So a Nifty index ETF can have a variable net asset value, that is NAV, throughout the trading period, while a Nifty index mutual fund will have only one single NAV for the whole day declared at the end of the trading hours. So these are the different types of mutual funds available for investors in India. That's definitely a huge list, right? And picking two or three funds for investing for long term is very difficult because we have so much choices. And this investment series from Market Secrets is designed to help you. So I hope you are following our series diligently. If you have any queries on the type of mutual funds that we have, or if I have missed out on anything, please drop it down in the comment section. I'll be happy to respond to that. Hit the like button if you have liked this video and share it with your friends if you find it useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we conduct live sessions. Thanks for watching. Have a great day. Goodbye.